Order blocks are a powerful way to track the footprints of institutions. But at times, relying only on order blocks may bring more losses than gains. This happens because using order blocks alone is not highly effective. Instead, it's better to combine them with a high probability confluence. And that's exactly what we'll cover in this video. Before we get into the strategy, if you find this helpful, please give it a thumbs up. And if you're new here, subscribe to our channel and turn on the notification bell so you never miss our latest uploads. We'll see you right after the intro and disclaimer. Let's first take a deeper look at order blocks. Order blocks are defined price zones where major institutional players such as banks or hedge funds place heavy buy or sell positions. These zones act as strong support or resistance levels that can influence price behavior when tested again. For instance, a bullish order block forms when multiple buyers place their orders within a specific range. As shown in this image, when the price revisits that range, it often triggers an upward move as those orders get activated. On the other hand, a bearish order block occurs when sellers dominate, creating resistance at a certain price point that typically drives the market lower upon a revisit. What we've explained so far is probably something you already know. But now, let's get into what you're actually here for: the powerful combination of order blocks and market structure. A break of structure takes place when price moves beyond an important prior level. Either a swing high in an uptrend or a swing low in a downtrend. This reflects a change in market direction and signals the potential continuation of the current trend. For example, if price breaks above a previous high in an uptrend, it reflects bullish momentum. In the same way, if price drops below a prior low in a downtrend, it indicates that bearish control is active. Our two consecutive break of structures strategy pushes the boss concept a step further. This method is built on the idea that when two breaks of structure occur in sequence, they create a stronger and more dependable order block. Here's how it functions. When price first breaks a swing high, that forms the initial break of structure, and when it later breaks another higher high, a second break of structure is confirmed. The range between those two highs becomes a support zone. Conversely, when price first breaks a swing low, that marks the first break of structure, and when it drops to an even lower low, the second break of structure is established. The space between those two lows becomes a resistance zone. By waiting for these consecutive breaks, we confirm that the market has shifted with strong momentum. Now, let's break down how to trade this setup effectively. The first step is to identify the order block by marking the price area formed after the two consecutive breaks of structure. Once the order block is located, we place a buy limit order at the top of the zone and a stop loss at the bottom. The next step is to wait for the pullback. In the same way, for bearish setups, after two consecutive breaks of structure, we mark the creation of bearish order blocks. Then, we place a sell limit order at the bottom of the zone with the stop loss at the top. When price returns to the zone and activates the limit orders, our trade will be executed. After that, we take profit based on our chosen risk to reward ratio. Let's consider a real case to understand how this setup plays out. On the screen, we have a USD chart. We notice the price creates the initial break of structure and then follows with another break of structure. This strongly signals a solid bullish bias in the market. Hence, we are well positioned to trade bullish order blocks. After spotting these two consecutive breaks of structure, once a bullish order block develops, we should highlight that zone. A bullish order block is identified when a bearish candle is followed by 5 straight bullish candles. After outlining the area, we must instantly set a buy limit order at the zone's high and a stop loss at the low. As soon as the price revisits the zone and pushes upward after filling the orders, we can finalize our target. It's advisable to set a break-even level on the trade at a 1-to-1 risk-to-reward ratio and place a target at a 1-to-2 risk-to-reward ratio. Furthermore, for proper risk control, never expose more than 2% of your capital on a single position. Now, let's examine how to approach bearish order block setups. Here we have a GBP/JPY chart. First, we need to spot the initial break of market structure, which gets confirmed with a second break. The pattern of lower highs and lower lows reflects strong bearish momentum. This makes bearish order blocks high probability trading setups. Once these breaks are confirmed and a bearish order block appears, We should outline the order block zone. Next, place a sell limit order at the zone's low and position your stop loss just above the high. When price retraces to the order block and triggers your sell order, you can then organize your exit plan. Shift your stop loss to break even once price advances in your favor by an amount equal to your initial risk. A 1-to-1 risk to reward, and similar to bullish positions. Target profits when the trade reaches a 1-to-2 risk to reward ratio. To simplify the use of this strategy further, I'm currently developing an update for our order block indicator. This upgrade will highlight order blocks formed strictly after consecutive breaks of structure. The indicator will scan markets in real time for these setups and mark the respective order block zones. This tool will reduce manual chart analysis and let you focus on higher probability trades. That's it, traders. Thank you for watching this video. I hope you gained real value from this video. If you did, make sure to hit that like button. It truly supports the channel and shows us you're enjoying the content. And if you're new here, don't forget to subscribe for more trading strategies. Thanks for watching, stay disciplined, stay consistent, and I'll catch you in the next episode.